Welcome and congratulations on entering the inner circle of senior living. The Inner Circle discusses relevant topics in senior living investment, operations, financing, and beyond to drive the industry to the next level. With a continually changing environment, let's start the collaboration now.
Hey guys, and welcome to the Inner Circle of Senior Living. I am your host, Scott McCorvey, and we've got a great show planned today. You ever seen the different prices or read a publication and you've heard the term cap rates and wondered how those pricing and values came to be, and what are some of the aspects that go into a valuation, or how can you even enhance a property's value? Well, today we're going to go over different valuation techniques that are used specifically for senior living. And I've said this multiple times, I'll say it again too. Senior living is unlike any other real estate class, and that is you can have the same location, the same site, the same bricks and mortar, have a different operator, have completely different financial results. And those financial results are a direct correlation to the property's value. So it's unlike any other real estate class. Senior living is specialized in itself. And I'm going to talk about some of the different things I've learned over the past, my past appraisal experience. I mentioned this before, but I started my career with a group called Health Trust, and they do a lot of senior living appraisals. They do all sorts of healthcare appraisals and market studies and different reports, but a lot of what they do is appraisals. And so I had a chance to really start my career, get a very solid foundation, understanding these valuation concepts and how they apply specifically to senior living. So today I'm going to share those with you, and I'm excited to do that. Now, if you're an investor, if you're an owner, operator, broker, lender, or just curious about senior living values, these are the same concepts and same techniques that everyone utilizes. So it's important to know this. If you're thinking about selling a property, if you want to just value your property internally, if you want to look for ways to enhance value, you really have to have a solid understanding of what I'm going to talk about today. So let's first talk about some of the terminology that goes into the valuation. First one is net operating income. I'll call it NOI. Also, it's EBITDA, but it's all of your collected revenues minus all of your operating expenses. And those operating expenses are your fixed and your variable. So your fixed being your real estate taxes, insurance, things like that. Your variable being your supplies, your staffing, all of those expenses. So it's all of your collected operating revenues minus all of your operating expenses. And this NOI is on an annual basis. So if you have 6 months of performance, you can multiply it by 2 to get the annualized performance. If you have 3 months of trailing performance, you can multiply it by 4 to get the annualized performance. But when I'm talking about NOI, I'm talking about your senior living's collected revenue minus your senior living's your senior living's operating expenses. This does not include your mortgage payment, does not include major CapEx expenditures that might happen in a certain month. It also doesn't include depreciation, which is more of an accounting non-cash item. So it's your income before the depreciation, your CapEx, and any mortgage payments, fixed charges like that. So keep that in mind. Next, we're going to talk about the cap rate, also known as the capitalization rate. Sometimes appraisers call this the overall rate, but it's all the same concept, and I'll explain it right now. The cap rate is basically, it's a calculation of your net operating income that we just talked based on the sales price or what someone's willing to pay. So just like in algebra, as long as we know 2 of the 3 variables, we can come up with a third. So you can calculate a cap rate if you know what an NOI is, or you can make a reasonable assumption of what an NOI is based on what the purchase price is. So as a quick example, let's say a property sold for $10 million and the buyer's year one, or the assumed year one NOI, was $1 million. Well, simply taking that $1 million, dividing it by the $10 million comes up with a 10% cap rate. And that's all it is. It's basically a reflection of what an investor is willing to pay versus what they expect to get in income. And we'll talk about different ranges for the different property types in a bit, but basically the cap rate measures the income based on the purchase price. Now, because of this, cap rates measure risk. Let's say you have level income. Some investors are willing to pay more versus other properties which they're willing to pay less. So there is a risk element that is factored in to the cap rates. Talking about risk, the lower, for the most part, lower acuity equals lower cap rate. Higher acuity is a higher cap rate. And again, that just measures the risk for the senior living property. So seniors apartments, age restricted apartments, even independent living, they typically have a lower cap rate compared to assisted memory care. And then the higher end of the spectrum is your skilled nursing and your post-acute. Again, we're just saying, okay, level income, higher risk, I want a higher reward. So post-acute has a lot more risk associated with it. So that's why the cap rate is typically higher. Other things that impact the cap rate are markets. Traditionally, a major market, if you have an infill location in a major market, that's going to have a lower cap rate compared to a property in a tertiary market that might be in a rural location. So again, things to consider. When you have an infill location, it's perceived as lower risk. You have a higher employee pool. You have more traffic. It's just perceived as a lower risk being in a major market with a strong infill location. Also, newer construction or higher building quality typically has a lower cap rate than a property that's older or has more of an inferior building quality. Stable operations typically have a lower cap rate than properties that have fluctuating incomes or have a lot of units to still lease up. Again, stable means lower risk for the investor versus multiple years of varying income that typically has a higher risk of trying to calculate what that income is going to be. So stable properties typically have a lower cap rate than properties that still have a lot of lease up or really fluctuated in past years' performance. Size of the property and the continuum of care. Size of the property, if you have 120 units, if you have a flu and let's say you have 10 move-outs 1 month, well, if you have 120 or 200 units, I mean, that's a hit, but let's say you have a property that has 40 units. Well, 10 move-outs with 40 versus 10 move-outs with 120. The 40 units is a much bigger hit to your operating performance. You're going to struggle that month. So that's why communities with a larger unit count typically have a lower cap rate than properties with a smaller unit count. Also, continuum of care. If you have independent assisted living memory care, then you have different options for the residents to age in place. You don't have to spend as much money in marketing and things like that to constantly attract a new resident pool. You have the continuum in place where residents can basically just move within your community and not have to find a new place to move to. So traditionally, communities with a full continuum of care have a lower cap rate than, let's just say, a standalone assisted living or a standalone memory care. So those are the main things. Also want to mention that the operator can impact it as well. So an investor is looking at a senior living community, they're thinking about who's going to manage this. If there's a very engaged operator manager currently at the property, they want to stay on board, that's a lower risk profile versus, okay, the investor is going to have to use one of their, a new manager coming in there that doesn't know the property. There might be some fluctuations with the transition of new management. Some residents might not be happy. There might be some staffing changes. There's just much more disruption that happens when you change management versus if you purchase a property and the manager wants to stay on board. So again, that's a lower risk having the manager stay on post-acquisition. So that's viewed as a lower risk. So it typically has a lower cap rate. Portfolio premium, and I've talked about this, and I also have a blog post if you want to read a little bit more about the portfolio premium, but it is prevalent in senior living communities. And the idea is that a single asset transaction typically has a higher cap rate overall compared to a larger portfolio. We're talking 10, 20 communities. And there's a number of reasons why. Again, talking about the risk profile, if you have one community and you have a tough flu season and you have 10 move-outs, that's a big hit to the operating income. If you have 10 communities and one of your communities have a bad flu season, have 10 move-outs, that's not a big hit to the overall income. So again, it's talking about risk. On top of that, Larger portfolios obviously have a higher price point. That higher price point is more attractive to the larger investment groups, traditionally the more institutional, larger private equity groups, as well as the larger healthcare REITs. And these groups typically have a lower cost of capital, therefore they're able to pay a higher price to maintain the same returns as a group that has a lower cost of capital, if that makes sense. So there is a portfolio premium. That is something that affects the cap rates as well. So something to think about if you're looking to sell one property versus maybe 5, there would be a premium associated with that. So we talked about NOI, we talked about cap rates. Now let's talk about valuation techniques. This is something that's utilized for if you're getting an opinion of value from a broker, if a lender is looking at your financials and doing their underwriting, if an appraiser has been engaged to actually appraise the building, these are all the same concepts that are utilized for any valuation of commercial real estate, but specifically I'm going to talk about the valuation of senior living communities. There's 3 approaches to value. There's the income approach, the sales approach, and the cost approach. High level, the income approach is what's primarily utilized. This is what we've discussed in previous, what I've talked about previously, but this is basically the concept of what an investor is willing to pay versus expected income. The sales approach is looking at sales within that area, preferably sales that are very similar to the property that you're valuing. And then coming up with some unit of measure. Typically it's a per unit basis and calculating that by the number of units at your community. The cost approach is not utilized as much for senior living, but the idea here is that you're willing to pay whatever the replacement cost is for this building. So I'm going to go into a little more detail in each one of these different approaches. The main one and the one that's utilized the most in senior living because of, as I said, the operational component of this, that it's real estate, but it's so reliant on the operations, which correlates to the actual net operating income. So the income approach is really what's used for senior living appraisals, or if you're getting an opinion of value from a broker or something like that. What you do is first you need to calculate what the appropriate year 1 NOI is, and that's inclusive of replacement reserves. Now, to calculate a year 1 NOI, there's a lot of different tools you can use. First, look at your prior year's performance. So I like to look at 3-4 years history if you have that available. Look at that net operating income based on the occupancy especially, and look to see if that's changed, if that's fluctuated. If it's stable, it's a lot easier. If you do have a lot of fluctuations, look and dig in to see why. Is it on the revenue side? Is it on the expense side? Is it an occupancy issue? There's a lot of different variables that go into this, but really understanding those prior years of income performance as well as year to date. That's the best indication, right? So if you have the last 5 months, look at those and you can annualize it to see what, the annualized performance is. Also, if there's any budget, we're new in the year here, so I like to see what the operator manager's budget is for the year. And if they've hit that in past years, or what their budget is for the year going on. If it's December and you got a budget from the prior year, not as helpful. It's still good to look at, but especially early in the year, it's great to see what that budget is. Take all that information and use that to calculate what your year 1 NOI is going forward. Again, the NOI should be a year 1 projection from today's date, or whichever date you're looking to value the property. There's a few things you can do if you do have unstable performance. You can look at the revenues and expenses on a per resident day basis, and I'll do an episode showing how to calculate that. But basically, it's taking the annualized performance and dividing it by the annualized resident days. Easy as that. If you do that, then you have some options if you wanted to increase the occupancy, you would increase the resident days. Multiply that by your revenue or expenses on a per resident day basis, and you have a fairly good guess, especially if it's a variable expense and not a fixed expense. You have a fairly good guess or a projection assumption on what that performance will be if you do lease it up, if you do have more residents in your community. So you utilize tools like a per resident day, also the same concept, a per occupied unit, same exact concept. Instead of resident days, you're looking at, you're not just multiplying it by the number of days in a year, but you're just using the occupied units. From there, you can lease it up and use that, multiply it by the assumptions that you came up with on a per occupied unit basis to see what the performance might be. If you're at 80% occupancy now, what would it be at 90%? What would it be at 95%? Just some simple tools you can use to try to project what that year one NOI is. Next, you want to calculate what's an appropriate cap rate. So we come up with a year one NOI assumption, and we're going to divide that by an appropriate cap rate. Well, what's an appropriate cap rate? There's lots of different ways to try to figure this out. First thing is ask your peers. Senior living investors typically have, their pulse on the market as far as what cap rates are, or what's being in the market, being utilized in the market at the time. Brokers absolutely know, and they've sold properties. They know what the income is. They know what the price was, so they have an idea of what cap rates are. Appraisers too. They're constantly tracking transaction information. Those transactions, part of it is, what the sales price is. You find out, you research what the NOI is, or you make a reasonable assumption. You can find out what the cap rate is. So the best way to do it is ask your colleagues, your peers, find out what an appropriate cap rate is. There's so many variables, as I mentioned before. We talked about risk reward, higher or lower cap rates. There's so many variables that go into it that sometimes it might even be a range of cap rates for that specific property. Also, a good way to find cap rates is just finding out what the announced sales are. So you probably are signed up for the email blast like I am. You probably get the monthly and quarterly publications like I do. All of these announce different transactions. Sometimes they announce the price and they dig into the financials. Other times they just announce the price and you need to research the financials a little bit. Or they might not announce anything, and that's a little bit harder. But utilize these publications to find out what the cap rate environment is. Also, who's the buyer? Is it one of the big three healthcare REITs? Is it one of the smaller healthcare REITs? Is it a large institutional private equity group? Is it a family office? Is it a new investor group? Those all go into it as well, as far as what they're willing to pay versus the expected income, and that's what the cap rate is really measuring. There's also different surveys that get released either on a quarterly or annual basis, but most of the larger brokerage firms, they interview investors and have what range of cap rates are for the different unit types. So that's a great way to do it. Also, brokers, a lot of times they'll release these surveys as well, either from prior sales or they'll what it's anticipated as far as a cap rate environment. But there's a lot of great surveys that get released that have very strong cap rate information in there. So those are the main ways to find out what an appropriate cap rate is for your property. One, talk to your peers, different investors, brokers, appraisers, lenders. A lot of folks will have a good understanding of what a cap rate or a range would be for your property type. Also, utilize the announced sales. Obviously, the most recent transaction data is the most relevant. The market's constantly changing, so the most recent sales have the most recent and the most appropriate cap rate information. And then look out for those surveys. Maybe reach out to some groups, appraiser groups or brokerage groups, and say, hey, do you guys do an annual survey? I'd love to be a part of it. That's another way to find out some good senior living cap rate information. Now I'm going to give just a broad range based on the different product types. As I mentioned, every property is different. There's so many variables that go into a cap rate decision. But just for the purpose of this show, I'm going to give just some broad ranges. There's about a 200 basis point spread between these, but for the sake of this show, I'm just going to give some ranges for the different product types. So we'll start with independent living. Typically, a cap rate is between 5.5% to 7.5%. Again, this is a broad range. It could be in the low end, it could be in the high end. It just depends on that specific property, market, operator, all those things I mentioned. Assisted living, we're looking at more of a 6.5% to 8.5% cap rate. Memory care is higher, of course. There's a higher acuity level associated with memory care. So we're looking more at a 7.5 to 9.5% cap rate. Skilled nursing is at the highest end of the range. And this is again based on net operating income, not based on lease income. That's a different calculation. But this is just based on straight net operating income. Skilled nursing typically has a cap rate between 12 and 14%. So your newer facilities that are more Medicare based are going to be in the low end. The older facilities that are more Medicaid based are going to be at the high end. So that's just a broad range if you wanted to utilize some of those benchmarks when you're doing your valuations. Again, there's so many variables that go into it, but that's just a broad range to give you an idea. If you have a continuum of care, let's say you have independent assisted memory care, how do you come up with a cap rate there? A lot of people say, we'll use the lowest level of care. That's not really the most appropriate. You can utilize the weighted average based on the number of units, taking into account these different ranges to come up with what a more appropriate cap rate is. So we know what the NOI is, or the EBITDA, for our year one projection. We've come up with an appropriate cap rate based on talking with our peers, looking at industry surveys, looking at recent transactions. Okay, we've got that great information. How do we come up with the value? As I mentioned before, as long as we know two of the three variables, we can come up with the third using some algebra. So the price of the value is equal to the NOI divided by the cap rate. So it's a pretty simple calculation. Again, look, using our example, let's say we have a property, we come up with an NOI of $1 million. Let's say we think an appropriate cap rate for this property is 10%. So we simply take that $1 million, we divide it by 10%, and we come up with our value, or our potential price, of $10 million. Easy as that. You can use it for all sorts of different property types and calculations, but that's the simple income approach valuation technique. Come up with your year one NOI, come up with appropriate cap rate, divide the two to come up with their value. That's the income approach. Let's take a quick break, and then I'll come back and we'll discuss the sales approach. We'll talk a little bit about the cost approach, or replacement costs, and then we'll talk about some ways to enhance value, because that's really where it comes into play, is how can we enhance the value at these communities. So we'll be back in a few minutes. This episode is brought to you by Senior Living Growth Advisors. Senior Living Growth Advisors can help you with the full spectrum of the investment and operation process. Whether it's structuring and closing new acquisitions, finalizing a development opportunity, accessing the specialized capital markets, implementing prudent asset management procedures, or just improving the operational efficiency of a community, let Senior Living Growth Advisors leverage years of experience and industry relationships to bring you to the next level. Visit srgrowth.com to learn more on how you can achieve your desired growth success. That's www.srgrowth.com. Hey guys, and welcome back to the Inner Circle of Senior Living. I am your host, Scott McCorvey, and today we are discussing valuation techniques and concepts specifically for senior living. So before the break, we talked about a few different terms, one being the net operating income, how you can look at your past performance and come up with an assumption for your year one NOI. We also talked about cap rates and how cap rates might be calculated or assumed based on different risk profiles and property types in senior living. Now, the income approach uses both of those. You take your net operating income, divide it by the appropriate cap rate to come up with what the value might be, or what an investor is willing to pay for that specific property type. So that's basically what the income approach is about. Next, we're going to talk about another concept in senior living valuation, and that's the sales approach. The idea behind this is that investors are willing to pay a certain price per unit for a property. So a lot of this information is easier to find than the actual income information. A lot of investors aren't willing to provide what their year one NOI assumption is for any given property based on the price they're willing to pay. On top of that, a lot of the sellers can't release information on what the financial performance is based on the sales price. So finding what the cap rate is a little more challenging than finding out what the sales price is per unit, because of the number of units at any given community is typically known. That's not as proprietary information than what your anticipated income is going to be. So finding out what the sales price per unit is a lot easier than finding out what a cap rate might be for any given transaction. And that's exactly what the sales approach is about. It's about finding similar sales of communities with the same, preferably size, acuity level, geography, building quality, market. All of those things go into what the sales are. So if you can find properties that have very similar qualities to your property and they have recent transactions, you can take whatever that sales price is per unit and then multiply it by the number of units at your community. Again, this works best for stable operations. It works best for higher quality communities where there's not a lot of anticipation as far as renovations or conversions or things like that. If it's a stable, high quality, recently built property, that is the best indication on a per unit basis versus a property that's older and might be going through renovations, has a lot of lease up, things like that. Because again, it's not taking the income into account. It's just taking whatever the property size is based on the purchase price. So let's do an example. Let's say that you're found sales within your geography, similar quality buildings that are stable, and let's say they've sold between $200,000 to $250,000 per unit. Now, the best thing to do would make some adjustments to those different prices per unit on the communities that sold based on your community. So if one is older, you might want to adjust up that sales price to match yours. If one is in a smaller market, again, you might want to adjust up that sales price. If one has much higher quality than your community, you might want to adjust down that sales price per unit. So using this example, it's again, we have sales prices of $200,000 to $250,000 per unit. Let's say our community is independent and assisted. These other sales are independent and assisted, so very good transactional data. Let's say we don't need to make any adjustments, that all these communities are very similar to ours. What we'll do then is we can either use a range, use that 200 to 250,000, or we can use an average. So let's say we use an average of the 225,000. We'll just do a straight average between the sales. And our community has 100 units. Well, it's just simply taking that sales price per unit, the 225,000, multiplying it by the number of units at our community, which is 100, and that comes up with a value of $22.5 million. So it's as simple as that. The best thing or the hardest thing is finding quality sales that match your community, because every community is a little bit different. Finding stable properties, again, it's not anticipating or it's not including any adjustments for the income. So if a property still is leasing up a bunch, that goes into the sales price, and that's not really utilized in this approach. It's just, a price per unit. But that's the basic concept behind the sales approach. It is easier to find this information available. Again, there's a lot of announced transactions with sales prices, and we can find the number of units. So this information is a lot more available than finding cap rate information on specific transactions. So that's the sales approach. Next, we'll talk about the cost approach. This one is utilized the least in senior living appraisal because it's basically has the concept. It doesn't take into account any of the income operations, what we call the going concern value. It's just a straight sticks and bricks behind the real estate itself. So the idea behind this concept is that an investor is willing to pay the price for a property versus what it costs to develop it, let's say next door. This works best for communities that have recently been built or newer communities. It's not as effective for communities that are much older or are about to go through extensive renovations or rehabs or things like that. So this approach, you take what's called the replacement cost. So you calculate what it would cost to develop this same community today. Let's say it's right next door. And then you take a calculated depreciation. Let's say it's 5 years old. You might take, we'll say an economic life for this community is 40 years. You take 5 divided by 40, come up with a depreciation value, and depreciate that from whatever your replacement cost is, your development cost new. Something to consider when we're talking about replacement cost is this includes both your hard and soft costs. So your hard costs, you might have a solid understanding of what that might be on a per unit or per square foot basis, but also consider things like the planning, like your architecture, like your financing fees, your impact fees, your FF&E. All of these also go into the total development cost. It's just not hard costs, it's hard and soft. Another thing to consider is what's called developer entrepreneur incentive. So developer is not going to create or develop this property for no profit at all. So on top of your hard and soft costs, make sure that you also include a percentage of profit for the developer. Again, they're not going to work on a project to break even. They're going to want some profit as well. So that should go into your development cost assumption. Once you have your development cost assumption, again, come up with a depreciation assumption. You simply subtract that depreciation from your replacement cost to come up with what the value could be using the cost approach. Again, it's not utilized as much for senior living, definitely not utilized for properties that are older. However, it is something to consider, especially in the environment we're in now where there's a lot of new development coming on. I always like to look at it, okay, well, I'm buying this property for this price per unit. Well, what if a competitor comes in down the road? What might they have total development costs on a per unit basis? If it's much lower, could they charge lower rates than I do? If they do, how is that going to impact my community and my occupancy? So something to consider, especially when you're looking at prices that top $500,000 per unit. It's a way to think about, okay, what would happen if new development came in? Is there new development in the area? Maybe it's so high because it's an infill location and any developer is going to have to go way outside the city limits to develop a new property. But it's something to consider as far as what you're paying for a property versus what a new developer might construct it for. And that's really, one of the more effective uses of the cost approach when you're looking at these valuation concepts. So those are the three approaches to value. We talked about the income approach, we talked about the sales approach, and we talked about the cost approach. Again, the income approach is what's primarily utilized in valuing senior living communities. How about enhancing values? So no matter what discipline you are in senior living, you're probably interested in enhancing the value of your community. And there's a couple ways to do it. The easiest way, or least challenging way, you have the most variables, is on the net operating income side. So first is, are you maximizing your revenues? If you're operating at 100% occupancy, maybe your rates aren't where they need to be. I always like to be in that 95% range because you're really testing the market. If you're 100% occupied with 40-person waiting list, maybe it's time to raise your rates some. Are your level of cares, are your additional assisted living cares being effectively utilized? Are you reevaluating residents on a quarterly basis, on a monthly basis, or is that just as needed, or is it on an annual basis? Having the right charges for the care provided is very important. What about your community fee? Are you using a lot of concessions for new move-ins? Are you waiving that community fee, or are you actually obtaining that, or could it be higher? Other revenues, other income streams, are there ways to get other revenues besides just the units and the level of care and things like that? Those are all things you can consider to really maximize the revenues. The other thing is to look at your operating expenses. Are you operating efficiently? And you can do that by looking at each different category on a per resident day or per occupied unit basis, maybe comparing that to other properties in your portfolio, or reaching out to some of your peers and comparing your statistics to theirs. I know primarily on a raw food cost what the per resident day cost should be. Also, different admin, supplies, marketing expenses, things like that. Just through my years of experience, I have a good, solid understanding of where that should be and if that's really high or even low to look at that. Another thing to look at is your staffing, and you can do a number of different ways to compare staffing, but one of the main ways is to look at your FTEs, your full-time equivalents, per resident day. And there's different statistics you can compare that to, or again, talk to your peers, but looking to see, is your staffing level appropriate based on your occupancy, or if there are ways to make that more efficient. Obviously, when you have some fixed positions regardless of your occupancy, but there are some positions that can fluctuate with your occupancy. So something to consider. Look at heavily on your marketing. on your admin in general, because those are the categories where I usually see the most cost savings, especially marketing, because that's the biggest selling point in senior living is your reputation. And you don't have to spend $1 of advertising, $1 of marketing to have a solid reputation. So are you really maximizing that reputation in the community through word of mouth, through referrals? That's really where you need to focus instead of spending more dollars on print advertising or placing agencies like a Place for Mom, things like that cost actual dollars versus your reputation that's selling itself. So always consider your reputation. That's one way you can lower your marketing expenses to enhance your value. Also, another huge category to look at and to analyze is your turnover. Turnover is so costly in senior living. It's high, but it's so costly. It's costly because every employee that leaves, you need to replace, and that costs real dollars as far as referrals, finding the right person to come in, and then training them. That all costs real dollars, and if they're leaving a month later, you're going to have much higher operating expenses than if you have employees that are not leaving, that are buying into your culture and staying with the community versus continually having to bring in new employees and train them and just keeping that cycle going. Turnover is so huge. That's one of the first statistics I look at in analyzing the operations of a senior living community. First, I want to understand their reputation, look at their marketing expenses, and then look at the turnover. Obviously looking at their staffing to see if that's most efficient, and then looking at different metrics on their expenses, seeing if there's any areas of improvement or any areas of concern. If your raw food is $3 per resident day, that's just too low, and you're not going to have the meal quality that's really needed for that senior living satisfaction. So something to consider. Another global way to look at your NOI is looking at your operating margin. And this is calculated by the NOI divided by the revenues, but it's a term that you can utilize. It's a metric you can utilize and compare to other senior living communities. So let's say your margin is 35%. Well, there's one down the road that's operating at 45%. What's the difference? Do they have charging more rates on the revenue side, or are they operating more efficiently on the expense side? So utilizing the operating margin is a good way to see how you compare to other senior living communities. So that's how you can enhance your value on the NOI side, and those are more in your grasp. The other side would be the cap rate, and that is harder to change because that's more based on market conditions and market fluctuations. However, some things you can do to try to lower your cap rate would be doing significant renovations. Maybe your property needs new flooring, new painting, new carpeting, new FF&E. Anything like that increases the overall quality. And again, we're talking quality higher quality has a lower cap rate. Also, unit conversions. We talked about lower acuity typically equates to a lower cap rate. So if you have a large percentage of memory care and a lower percentage of independent living, maybe you convert some of or a better example would be assisted living. You might want to convert to independent living. That's an easier conversion, but look for ways that you might be able to lower your level of care, because that does usually equate to a lower cap rate. Also, having a continuum of care usually equates to a lower cap rate too, and I mentioned that before, as far as a resident aging in place lowers the risk profile of the community. So if you have independent and assisted, maybe you want to add some memory care. If you're just assisted living memory care, maybe you think about adding some independent living villas. Anything to try to enhance the overall quality and the overall continuum of the property typically relates to a lower cap rate. So all things to consider. Also, the operator manager, I talked about this before, but if you're looking to sell the property, an investor is going to look at who's currently operating it or who they need to bring in as far as operations. So maybe making those operating decisions now can help enhance your value on a cap rate side. The last thing, as I talked about before, you can impact your cap rate if you're within a portfolio of senior living communities versus a senior living asset transaction, a single one. So having a portfolio of 10, you'll have a lower cap rate typically than just a single asset. So those are the basic concepts to enhance your value. I'd love to hear from you. Feel free to email me at scott@srgrowth.com. Shoot me an email. Let me know if you have any questions or concerns. Let me know if you have any show concepts or ideas. If you have any interviews you'd like me to reach out to folks, or just email me and say hi. We'd love to chat with you. Look forward to meeting you. Make sure you join our social media. We are on the Gram, the Instagram. We are on LinkedIn. We are on Twitter. We have a YouTube channel. All ways to get involved with the community. So there'll be questions and concepts and theories that are posted. We'd love to get your interaction, get you involved. So make sure you sign up for that. You can go to the website srgrowth.com. If you go to that website, you'll see an option in the top called Inner Circle. Click on that, and that'll have a link to our shows as well as a link to all of our social media accounts. So that's an easy way to get involved with everything. Be sure to subscribe to this show if you're using iTunes or whatever podcast platform you're using. Be sure to subscribe so you can get the latest shows when they're released. And I would love it if you could review this. Review it on the platform, or just tell your friends and colleagues about the show. The more people we can get involved in the inner circle, the better this show will be. That's it. I hope this was helpful for you. I hope you learned some concepts that can help you either valuing your current property or some concepts to think about in the future to really enhance and maximize that valuation. That's it for this show. Now go out there and make a difference.
We appreciate you participating in the Inner Circle of Senior Living. Now, it's your turn to help spread the message. Be sure to share your questions and comments with the Inner Circle community and discuss the different topics with your friends and colleagues. Until next time, thanks for joining the Inner Circle of Senior Living.